Remember the first 2 weeks we were dealing with revenue and expenses, the sales return, sales discounts, the cost of goods sold when we sold inventory, and then of course our inventory account here. And then last week we looked at cash and receivables. And this week we're going to do the bottom half of the assets, the long-term assets, in dealing specifically with depreciation and selling of assets with a gain or loss. I listed up here the three types of depreciations we're going to look at, and there's a few new terms that we'll have to know as well as we look at the depreciation. Let me turn this off for now. When you deal with the most common is straight line, and that's what we've already know how to do. You already know how to do straight line. We're just going to expand the straight line just a little bit. So with straight line depreciation, the basic formula that you know most of it. There's only one little piece that you don't know, and we'll talk about that. Is we need to take. Remember, we take the cost of the asset. The very bare bones is the cost over the useful life. So if you had a $10,000 asset over 5 years, it's $2,000 a year that you're going to depreciate. Well, we're going to add a little bit extra. Cost minus the salvage value. Divided by, and I'll explain salvage value in a minute, divided by your estimated useful life of your asset. Remember, management determines the useful life. They make that up. They determine, it's not working very good. I don't know why.
Yep.
I'll just put it up here. I'll fix it. Okay. Cost minus the salvage value. Also, we're going to find that we typically will use the cost, but if we've already depreciated the item and we have to change something with the asset, as like you'll see in a minute, if we add a capital expenditure, we're going to use whatever the book value is of the asset, the cost minus its accumulated depreciation. Usually you're going to use just the cost because you won't have any depreciation yet. But there are occasions where we'll have to use the book value instead of the actual cost. Now, salvage value. Salvage value, I'm going to abbreviate it, also known as residual value. If you hear that, either one, they mean the same thing, kind of like drawings and dividends. So they're synonymous terms. What that is, what that means is that's the company's estimate of the asset's fair market value when they're done with it, or at the end of its life, at the end of its useful life for the company. Not everything in a business does the business use until it's ready to be thrown out. Some of the items they use and it can still be used and sold to somebody else. They just need the newer and better stuff. I like to use the example of a rental car company. Enterprise doesn't have on its fleet 5 to 10-year-old cars.
What is that FMV symbol?
Fair market value. So Enterprise doesn't have a 5 or 10-year-old vehicle. Usually they have 3 years or less on them, and then they update it. They don't just throw those vehicles out. They sell them or sell them for parts and get something out of it. That's what the residual value is. Enterprise may have a useful life of 3 years. I don't know, but it's about that. And then their residual value, if they bought it for 20, maybe the car is still worth $8,000 at the end of the 3rd year. That would be their salvage value. What they plan on selling it for when they're done with it. So that's something we have to take into our equation when determining depreciation. What's, just in real general terms, somebody tell me what does depreciation even mean? If somebody asked you, I heard about this word depreciation, could you even give them a clue of what that means?
How much value decreases over a certain amount of time?
Close, but I hate to use the word value because you might confuse that with fair market value. That doesn't mean the value of the asset actually dropped.
The price?
Right, it doesn't mean the price dropped.
Wouldn't it be like if it's like you use it daily, and you take off so much for that, for having used it for a year.
Yeah,
It's like taking off for being worn out for a year or
Right.
something each year.
okay. Anybody else?
Is it considered like a decrease in your inventory? Or?
No, it doesn't have anything to do with inventory. Inventory is goods that you sell, that you use in the business, that you actually sell. If I was selling staplers, this would be my inventory. Depreciation isn't dealing with inventory. And
It's like we have, let's say, a refrigerator, and you use it every day, and it wears down just a little bit every day, a little bit every day, a little
Yeah.
bit every day. And I consider that a type of depreciation where a product or piece of furniture begins to deteriorate.
okay, yeah, what basically you're all saying is you're allocating that expense over a whole bunch of years. It would be incorrect to say I had a vehicle expense of $16,000 and list a vehicle expense for $16,000. That vehicle isn't going to last me just a year. Better not. Okay? That's why I have to put it over here in the assets. I'm going to own that vehicle, and then a little bit of it I'm going to use every year for the next 5 years or 10 years. So depreciation is, you're not spending money. Depreciation has nothing to do with cash. Has nothing to do with replenishing an account to rebuy an asset. If you're going to repurchase an asset later in 5 years, depreciation doesn't have anything to do with that. It's just simply showing that you're expensing something a little bit at a time instead of all at once. Let's look at an example using the straight line method. And let's use these parameters. We've got, let's say we buy a vehicle for $19,000. And let's say I bought it 7/1 of 14. And now let's make it 10/1. Let's make it October 1. 10/1. And let's say it has a 5-year life. And let's assume a $4,000 salvage value. And then I ask you, I want to know, what's the depreciation expense per year? And what's the book value per year? And I want you to tell me what they are for 2014, 2015, and 2016. So I would make a little chart. This is my depreciation expense column. I'm going to have an accumulated depreciation column, and then a book value column. Depreciation expense for the first year, 2014.
Would it be zero? Because you just got it?
True, we did just get it, but we got it in October. So how much time has elapsed? Because remember, we always do our depreciation at the end of the year. So on December 31, These are the dates. So a little bit of time has elapsed. 3 months.
You have to find out how much it is for the year, and then only use 2 months of it.
3 months.
3, yeah.
So, yeah, tell me that.
About $950.
$47.50 for the 3 months?
Uh-huh.
Oh.
Surprise yourself?
Yeah.
I bet it's $750. That's what it is. So let's see how you got that. We fill in the formula. Here's my formula. Cost of 19 minus the $4,000, what I plan on selling it for, or what I think it's going to be worth when I'm done. $3,000 per year is my typical expense. That's my yearly expense. But I didn't have it for a year. I only had it for a quarter of a year. So I need to take that $3,000 over a quarter of a year, or 3 over 12. So if I was looking at my T accounts, I have a $19,000 asset, accumulated depreciation after year 1 of $750, and a depreciation expense of $750. $2015, how much is my depreciation expense? Oh, look, I gotta finish this out first. What's the book value of my asset after 2014 is done?
$14,250.
That's a very common answer, but it's not right because it's not $14,250. It's very common, though, to say that. What's the book value?
Out of the 19, you take it from the 19.
Yeah, you don't take it from with the salvage value. You take what is the asset worth minus how much I have depreciated. The salvage value is only used to calculate depreciation. So my book value is simply these two combined, netted. 2015, how much depreciation do I have?
3,000.
Yeah, the full amount, 3,000. I had it the entire year. So in my accumulated depreciation, I have $3,750. I'm not totaling this column because these are 2 separate years. And the depreciation would have been wiped out at the end of 2014, back to 0. So my book value, take the difference again, 19,000 less 3,750. You'll see why keeping the book value is going to be important here in a minute. Or at least knowing how to calculate it based on your T accounts. Now, let's say we're going to do 1 more year of depreciation. That's easy to do. Another year went by, another $3,000, another $3,000 added in here. On 2017, I have to replace the engine. This gets us to a new thing we need to talk about. The difference between capitalized versus ordinary expenses. If I buy a new engine, that's a pretty big deal for a car. That's a lot different than having an oil change. So it's treated differently too. Capitalized expenses, if it's a capitalized, and it's, the correct term is actually expenditure, it's not an expense. Expenditure versus ordinary expense. If something qualifies under this category as a capitalized expense, I have to add it right here to the vehicle or to the asset. For the example that I was using, the engine, and I'll go through the qualifications in just a second, but the engine would qualify as being a capitalized expenditure. So one of the big reasons it's a major overhaul. For something to be a capitalized expenditure, typically it does the following. It increases the useful life, makes it last longer. And it increases the value of your asset. Makes the value of it go up. Ordinary expenses are more typical normal repairs and maintenance. So if you had a vehicle on your books and you had an oil change, that's a typical repair or maintenance item. You would actually go over here and simply put vehicle maintenance expense, or however you wanted to expense that out, whatever terminology you would want to use, and you would put $40 vehicle maintenance expense. And maybe if you had to put on some lettering on your car, well, you could call that advertising. But any other little ordinary things are going to go here. Something like an engine. An engine's going to make your car probably worth a little bit more than it was with the older engine, and it's probably going to make it last longer. That would be a good example of a capitalized expense. And when you have a capitalized expense, whatever you purchase, you debit the asset account directly. And don't expense it. So if I bought an engine for $2,000, I would debit vehicle, my car, and I added $2,000 to the price of that car, the value of that car, and say I paid cash for it. So I would come over here and put $2,000 in my T account. Actually going to have to depreciate that engine now with the car. And that's what I want us to assume here in 2017. We installed for $2,000 a new engine. And let's assume this happened on the beginning of the year, 1/1/2017. So installed a $2,000 new engine. Let's say it increased the useful life. Oh, let's make it not very much, only 1.25 years. And let's say the new salvage value with the engine, I think I'll get $5,000 instead of $4,000 now, because I put a new engine in. So what I want us to be able to determine then is that for 2017, at the end of the year, the same thing. What's my new depreciation expense and book value at the end of 2017. This is where it's going to be very helpful that we have this old book value. Because remember my formula? We're going to use the cost typically if we just purchase the asset. But in this case, since we added into it, I don't want to depreciate the whole $21,000. Why do I not want to depreciate? I forgot to add the final year's depreciation, 2016. Why do I not want to use $21,000 as my base number, the cost?
Should you put money into it?
True, yep, the money I put into it's right here.
It's already been depreciated, so.
Yeah, I don't want to depreciate. Look how much has already been depreciated. $67.50. I can't re-depreciate that.
Say you wanted to sell it, and you wouldn't sell it for the 21, you'd sell it for the 12. You know what I mean? Does that make sense?
Yeah, we're going to get to that, to selling it in a second, and I think hopefully I'll explain that. But right now, when I'm doing the depreciation, I don't want to use this as my only number. I've got to take into consideration that I've already depreciated this much. So when I come back to do my equation, cost, not a good option here. I got to take the book value. My new book value, I could do it one of two ways. I could just simply look at this and get the book value. Or I could come over here and say, this is what my old book value was. I just added a $2,000 engine. So my book value is $14,250. And you're going to get $14,250 if you do this subtraction here. Same thing. Either way is fine to get your book value. I need to subtract out my new salvage value because, well, my car's a little different. I think I'm going to sell it for maybe a little bit more now. How much life do I have on the car?
Should have like 3.5 years now, because you had
Close.
a year and a half for the engine, because you figured it made the life of the engine, or the life of the truck go to 1.5 years.
1 1/4.
1 1/4.
1.25.
So you've got 2.25 left.
True, good. That's what you got to start with. I started with 5. I got rid of a quarter here. So that leaves me with 4.75 left years. Are we good there? I've only used a quarter of a year this first year. Then I used another full year, so I'm 3.75. 2.75 years left. But how many years left do I really have now with the new engine? 4. 2.75 years left before I made any changes. Add another year and a quarter to 2.75. I got 4 years left on that vehicle, what I think I'm going to be using it. Now this isn't going to come out to anything nice and neat. But somebody do this. What's that? 9250 over 4. What's that come out to be?
$23.12.
23, okay, we'll just round to the nearest dollar. 23.13. Somebody else get that too?
Yeah.
Okay. So my new depreciation expense no longer is $3,000. I've had to recalculate it. So I'm going to depreciate in year 2017 $2,313. my new book value. Whatever the difference is between 21,000 and 9063. What is it? Somebody tell me.
11,937.
11,937. Okay. Last thing on our example here. On 7/1 of 2018, we sell the vehicle. And we sold it for $6,500. I want us to be able to prepare the journal entry for 6/30 and for 7/1 to show the selling of my vehicle. What do you think? Does it matter that I sold my vehicle before the useful life ran out? Do you think I need to go back and redo stuff? Because I sold this, I said here that I had 4 years left. Well, I decided I was going to sell it after just 1.5 years. Do you think that matters? What do you think? What do you think I got to do, or anything? I sold it only 1.5 years, but when I did the equation, I did it by 4 years.
Then you have to figure out the current book value.
Okay, well, I'm talking about prior years now. Do I need to go back and do anything showing, because I did it, I thought I was going to have it 4 years, but I only had it 1.5 years. What do you think? Do you think you'd have to do anything or not?
Oh, you'd have to go ahead and, as the last, like for the last entry for the accumulated depreciation, the rest of the depreciation that you would have had you
Okay,
went the full 4 years.
okay, could do that. That's an option.
Hadn't you had it 4 years? You got it in 2014?
Well, yes. I mean, I've had it. Remember back here, I thought I was going to have it 5, and then I needed to add another 1.25 years. So really, I needed to have it 6.25 years.
Oh, okay.
So does it make a difference that I didn't quite have it for as long as I thought?
As long as you, I feel like if you only take off the appropriate depreciation for the amount, for the average span of life, the life isn't what's changing, it just depends on how much you sell it for how long you had it. So if it has a life of 5 years and you sell it your first year, as long as you take off the appropriate depreciation, I don't think anything else.
Yeah, I think you got it right there. We don't go back and change anything. This 4 years is an estimate. We don't really know what it's going to be. That's just what we think it's going to be. And if it's not right, it's not right. It's all right. It's just our best guess. Same as this salvage value. I thought I was going to sell it for $5,000. I sold it for $6,500. That's all right. This just gives me a good starting point. That's all it is. It's nothing set in stone by any means. 6:30 comes along. What do I need to do before I actually do the journal entry to sell it?
Depreciate.
Yeah, I need to depreciate another half a year. I had it from the end of 2017 when I depreciated it for another half year to July. So how much am I going to depreciate in 2018?
It's still the 2313.
Well, that would be if I had it for the entire year.
1156.50.
Okay, let's just round 1157. I cut this in half because I only had it for half of a year. I can't use my entire year depreciation amount. The entire 2313, I can only use half of it. So my journal entry would show, I would be doing journal, every time you see a number here, that's a journal entry. I'm just happening to only do it for this last one. Depreciation expense, 1157. Accumulated depreciation, 1157. I got accumulated depreciation of 11,220. I think that's right. And then a updated, ready, the final book value when I sell the vehicle being 9,000. 9,780. Somebody can check my work. I think I did it right.
1078. That's 10,780. Sorry, that's what I got.
Yeah, I got
It's 10,220.
Yeah, it's 10,220.
10,220? Okay, thank you. So wait, that doesn't seem right.
That's 10,780 and 10,80.
Oh wait, I put the wrong number here?
Yeah.
Oh, okay. What is it here?
10,220.
10,220.
Oh, okay, I see what you're saying. 10,220 there. And then what's my updated book value?
10,780. Right?
Yeah.
It sounds too high. If you take 21,000, oh wait, this number was not right. It was 10. Okay. Okay, I see that. It wasn't 11. The asset on my books is worth 10,780. I sold it for 6,500. When you have extras out there, you kind of have two net incomes. One from your normal operations, and then one final one that includes any odds things that are not typical in a year. And you want to separate those out for anybody looking at your books, because you don't want to have a big loss one year and it looks like you did terrible that year. When you really didn't, you just had one weird thing that's not typical. If you didn't have that one weird thing, your books would have been normal. So we keep that separate and we account for it in a different spot than our normal expenses. Okay, let's try a couple examples. Look at number 33. On the first one, I'm kind of combining a few of the things that we've done in the past. Make sure you've got it down. Yeah, it'll come on in a minute. Okay, so what I asked you for number one is, let's determine and do the journal entry for the depreciation at the end of the year. And find the book value of the asset. And we're doing straight line this time. That's the only one we know so far. We'll get to the others in a little bit. Notice the date here and what I did. I bought in July new computers. And then I tell you what the sales taxes were and delivery charge, useful life, and then there's total a $250 salvage value. So using all of that, I want you to be able to tell me what the depreciation expense is what the journal entry would be for this asset. And then below it, what the book value is. For the initial purchase of the computers. But what would your journal entry have been if you needed to record the purchase on 7/1/2014? What would I have debited and how much? Computers, yep. And how much?
5,500.
Good, 5,500. Not 5,000. I'm going to debit 5,500 because any costs to get the item ready to use or sell is included, and I need to depreciate it. So I need to include in the sales tax and that delivery charge, kind of like FOB shipping when you buy inventory. You include that delivery charge in your original cost. Anybody get the depreciation expense yet?
Would be 750.
Not 750. Cost of our asset less the salvage value over the useful life gives us 1,050 for a yearly basis. But we didn't use it for a year the first year. So my journal entry, your final answer there would have shown your journal here of $525, debit to the depreciation expense, credit your accumulated depreciation.
Was it just one computer or two?
Both computers together add up to $5,000.
Okay, when I was figuring out the accumulated depreciation, I came up with like 1,050 between the two of them, so.
Well, 1,050 is the yearly amount. See up here?
Mhm. So, yeah, okay,
But we didn't have it for a year.
okay.
I bought it in July.
Oh, okay, I didn't see that.
What's the book value? The final part of this part one answer.
4,975.
Mm-hmm. Book value, cost minus how much I've depreciated. On January 1 of 2015, I don't require you to show the purchase, but I'm going to put it up on the board over there. One of the next year, whatever the next year is, we'll assume 2015. What am I going to debit? And for how much?
Computers.
Computers, why? Why not hard drive expense?
Because you added it to the asset, you purchased it.
True. And what do we call that kind of a purchase when I need to add it into the computers? Capital expenditure. And why do you say it's a capital expenditure and not an ordinary repair?
Because it adds useful life.
Yeah, it adds useful life. So when I added this hard drive, how much?
$700.
Yeah, 700. I'm adding 700 to the actual cost of my computers, because that's a major component of a computer. It's not like replacing the M key on the keyboard.
For computers, is that just like another way of saying it's equipment? Is that right?
Yeah. I'm just, instead of putting vehicle or machine, yeah, equipment can be broken down. I'm just breaking it down to exactly what it is.
Okay.
So now determine, with the new stuff you got, determine the journal entry for the end of 2015. $850, yep. Let's look at it. First thing I did is determine the new book value for my equation. Remember the equation, since we can't really use costs anymore, I've got to use book value. There's a couple different ways. You could have just said, okay, old book value plus new stuff equals the 5675, or you could have done it the longer way and did it the T account. 6200, these two guys, subtracting out the accumulated depreciation, also is 5675. And then plugging into the equation. New book value minus salvage value. Divided by the 6 years that are still remaining. How'd you get 833?
I added it correctly.
Oh, okay.
I think I did the same thing, and I didn't account for the time that we had already depreciated for.
So what did you use as your day, as your time?
6.5 years instead of,
6?
yeah.
Okay. When you get done with that one, when you get updated, turn over, go to the next page. We're going to get back to 2 and 3 once I go over those. But look at number 4. You should be able to do number 4. You have an asset on your books, I tell you, that is valued at 20, that you bought for $20,000. And so far, you have 13,000 in the accumulated depreciation. That's what the balance sheet would have looked like. So that's what your T accounts look like. On the next day, on 2014, we're going to sell the asset. And we're going to sell it acting like 3 different prices. See how it's different with 3 different ways. What's your journal entry going to look like for A if you sell the asset for $11,000 cash? Let's assume it's cash. Doesn't have to be. You can make it whatever you want. What's the book value on my equipment? What's the equipment worth on my books?
7,000.
Yeah, 7,000. I sold it for 11. What do you think you had? Did you have a gain or a loss? You had a gain. You brought in 11. It was only on your books for 7. So you gained 4,000. And that's how you're gonna set up your journal entry to get rid of a piece of equipment. What did I get? Cash. How did I get it? Well, I got rid of my asset, and I got rid of the accumulated depreciation, so I have to get rid of them. So I have equipment of 0, and I have accumulated depreciation now of 0. And if you would have stopped there, this doesn't equal. 24,000 debit doesn't equal my 20,000 credit. So we offset that, showing that we had a gain. I brought in more money than it's worth on my books. Now B is very similar, except you brought in quite a bit less. And how does that affect your journal entry? You still got cash, just not as much. Still got rid of your equipment. Of what?
5,000.
5,000, he's right. And then in C, you didn't get anything for your asset. You just had to get rid of it. You had to throw it out. So you still have to take it off your books. If it helps, you can debit cash for 0, although that's not really what you do. But if it helps you to visualize it, you can say cash of 0. And what would your loss be on part C?
7,000.
Yeah, all of it. We've done straight line. We're going to begin double declining. I'll probably get through most of the discussion on double declining. We probably won't get quite to the practice one yet. But we're going to look at the second option that a business has. Remember, a business has the option of doing FIFO, LIFO, or average cost. Same thing here. When you buy an asset and you start appreciating it, the owners kind of pick which one they want to do. Straight line would be for if you just want the most simplest method, or if it makes sense because your business uses the asset very evenly throughout its entire life. You use it the same amount in year 1 as you did in year 5. Double declining would be very good to use if you use your asset a whole bunch right up front. That's how some assets work. You buy it and then you work it real hard because it's brand new, it's the best of the best. You're going to put in the most hours into it. And then as it gets to be a little older, you still use it some, but not nearly as much. And after about 4 or 5 years, you're just using it sparingly. And if you want to kind of do your expensing that way, you can depreciate it a whole bunch in year 1 because you're using it a whole bunch in year 1. It kind of makes sense. And then when you're not using it so much in year 5 and later, then you just depreciate it a little bit because you're not using it very much. So it might make sense for some businesses to do this double declining. With double declining, there's a couple key things that we need to know. The first key thing is the salvage value is only used at the end. Not the beginning. Not the beginning formula like with straight line. What I mean the end is the salvage value, the book value, must always be greater or equal to the salvage value. Okay, your book value cannot drop below the salvage value. So if you have a salvage value of $5,000, the book value of your asset better never go below $5,000. That's one of the rules of double declining. Since you don't use salvage value in your equation, you just got to make sure the book value doesn't drop below. Second thing is when we determine what our depreciation percentage is, it's going to be double that of straight line. And I'll give you an example. If I was to depreciate something over 5 years, what percentage is 5 years if I was to do it every year for 5 years? How much of an asset's value am I getting rid of after 1 year?
20%.
20, how'd you get that?
Just divided 100 by 5.
Or you took 1 over 5.
Yeah.
1 year over 5 years total. I'm using it 1 year. I'm going to have it for 5 total. So that means I'm using it 20%. Well, with double declining, it's double that. Whatever your straight line number is, take it times 2. So if it's 10 years, it would be 10% times 2. Now, given those 2 items, we can begin to set up a little chart to help us. I think you'll see it helps to do double declining this way. Sorry, don't start with that one. We're going to have that one more in the middle. Year, we'll start with year 0, our purchase year. Depreciation percentage. Depreciation expense. Accumulated depreciation and book value. When we're doing double declining, it's not like straight line. It's going to be different every year. So we have to kind of recalculate it every year. It's not as easy as straight line where it's just 3,000 every year. Let's go back to my original example that I had up here. Almost everything's identical except, let's assume instead of purchasing the asset in July at the half year, let's assume we bought it at the beginning. It'll make this one easier. So at the beginning of 2014, I bought my vehicle. So I got the vehicle at 19 on my books. What's the, in the first year that I bought it, year 0, what's the book value?
19,000.
Yeah, 19. I haven't taken any depreciation yet. So it's just its purchase price. Now the end of year 1. If it helps you, end of year 1. My depreciation percentage. Well, I just happen to have the same amount that I did as my example. 5-year useful life. So 1 over 5 is 20%. That's what straight line would have been. But I'm going to multiply that by 2. Your depreciation expense when you're doing double declining equals your previous book value times your percentage. That's all you got to do. Take the full 19,000 times 40%. No salvage value taken into play yet. What do you get? 7 what?
600.
600. So I would have a depreciation expense of 7,600. Debit. Credit my accumulated depreciation, 7,600. Compare that back to straight line. What was the first, well, don't include the half a year, but what was the first full year of my straight line depreciation? How much was that?
3,000.
Yeah, 3,000. More than double. So you're remember, this is assuming you use the asset real hard, real fast. You're going to really put it to use every day, 24 hours, always in use. That's kind of the guideline, the thinking behind double declining. You're expensing things real fast because you're using it a lot. Book value, 11,400. Again, I could have looked at the T account to get the book value. I could have said my price minus the accumulated depreciation total. What about year 2? How much am I going to depreciate in year 2?
4,560.
Okay. And how did you get that?
I multiplied the balance 11,400 by 40%.
Yep, 11,400, the previous book value, what my little formula says, times 40%. So my updated accumulated depreciation, I got 12,160. Notice the depreciation dropped off quite a bit in year 2. Assuming I'm probably using it a little bit less in year 2 than I did right off in year 1. What's the book value? 6. 840. Now I'm starting to get close. I want to start keeping this number in the back of my mind. 6,840 is getting close to what? The salvage value. This is the book value.
Okay.
I've got to start looking and thinking about this. My book value can't drop below the salvage. My final number, whenever it comes, it has to stop at 4,000. Let's see if I hit that point or not. How much? What we should do and think about it is, how much do I have left before I have to stop for sure?
2,840.
Yeah, 2,840. So my next depreciation expense, if it's more than 2,840, I can't do it all. What is it?
2736.
Yeah, 2736. It's just below the cutoff. If you took 6,840 times 40%, we almost got there, but we didn't, so we can use it all. I can use all 40% again. I think I got, is that right? Is it adding right? 14,894? I don't know, I just...
Got 896.
896, okay. 896, and over here we've got 4,104. Now I've only got $104 left. So what do you think my depreciation expense will be in year 4? $104, yep. I can't go below the book value, so all the more I can add to my accumulated depreciation is $104. How much is it in year 5? This is a 5-year useful life.
0.
0, right.